Well, today we're going to be getting into the basic tools of finance. And what this chapter's overview is an exploration of tools utilized by the finance industry in order to answer such questions as how do we determine the value of a good? What do we determine the price of financial assets? How do we determine how their price is going to change over time? Just straight from the get-go, we're going to hop into something called the present value, and this is measuring the time value of money. So what exactly is the finance industry? What does the finance industry do? Well, it's the field that studies how people make decisions regarding the allocation of resources over time and the handling of risk. So finance asks the question of what do we do with things like our money today, and how is this going to change over time? And whenever we're talking about the future, right, there's a certain degree of risk because none of us know exactly what's going to happen in the future. And so it's important that we come up with some kind of tools that allow us to at least wisely gauge what could happen. We don't know what companies will be successful. We don't know what companies won't be successful, but we can take a guess, right, that some will go bankrupt, others will thrive. And we can take a guess that some investments are better than others, whether it's in capital or education, etc. And so the present value, this is the amount of money today that would be needed using prevailing interest rates to produce a given future amount of money. So let's just say, for example, that you want to retire with $1 million in the bank account. The present value is the amount of money that you would have to have in the bank account today that allowing just the standard growth of interest, how much would be required for it to go up. So for example, or to reach $1 million in the future. So for example, if you had a 5% interest rate, what amount of money today compounded 5% annually, however many years until your retirement would it take in order for you to have $1 million? That's the present value. Now, it's so fascinating that when asked what he thought the most fascinating thing he learned was, Albert Einstein said it was the power of compounding. And basically what is the accumulation of some money in, say, a bank account where the interest earned remains in the account to earn additional interest in the future. So let's just say you have $100 in the bank. If you earn 5% interest, then you would make $105 at the end of the year. But what's cool is that the next year you earn 5% again, but you earn 5% not only on the $100 in that account, but also the 5% in interest you earned the year prior. So how does this work? Well, let's just say that you have some growth rate interest return called 1 plus R times 100. And what this is saying is that you can determine how much money you're going to have at the end of the year by adding 1 plus a given interest rate times 100. So if you have a 3% interest rate, you would say 1 plus 0.03 times 100 tells you how much money is have in the account at the end of the year. So the 5% interest rate, you do 1 plus 0.05 times 100, and that would give you $105. Now, next year, this is calculated as 1 plus R, so 1.05 times 1.05 times 100. And that would give you the amount in your account at the end of 2 years. Now, if you repeat every year, you keep on adding 1 plus R for each additional year. So generalized, we can write this equation as 1 plus R to the n times x, where R is your interest rate, n is the number of years, and x represents our principal, i.e. the amount we start with. The example I mentioned up here, our principal is $100. So what this tells us is that let's say that you have $100 and you want to know what the value of $100 will be 20 years from now at a 3% interest rate. What you would do is you would say 1 plus 0.03 for the 3% interest rate, 20th power, because again, in that example, in our time horizon is 20 years out, times x, which is $100 in this case, which is our principal. And that would give you what $100 at 3% interest rate will equal 20 years from now. Now, the present value then, this is what we were talking about up here, the amount of money today needed to get a prevailing amount of future in the money, can be understood as x over 1 plus R to the n. So if we know the interest rates and we know the years on the horizon, we can figure out what the future value of X would be in the future to have that amount of money. Now, there's something really fascinating about this because we don't know that the market's going to grow at an interest rate of simply 3% or 4% or 5% in the future, right? There is a degree of risk. It could go down, it could go negative. So, managing risk is one of the key things that the financial market is interested in. And this is also at the core of the question of markets for insurance. So, at the core, we assume that people have a dislike of uncertainty. That is, most people are risk averse. Just note here that, again, averse means not liking something. So, by saying we are risk averse, we are saying that we dislike risk. The utility function for risk averse is what we see in figure 1. Now I want to pause here for one moment because you might be wondering, what's a utility function? A utility function is basically a function which describes to us how satisfied we think someone is from the amount they get. So utility is this fictitious measurement in economics we use to kind of express something like satisfaction without necessarily knowing how to measure happiness. So if you tell me that this gives me 20 joules of happiness, I don't know what that means or how happy that makes you, but I do know that if you said something gave you 15 joules of happiness, then you prefer what was 20 joules over something that was 15 joules. So this is an example of simply a way of giving us a nominal means of measurement. This utility function shows how a subjective measure of satisfaction works upon wealth. As wealth rises, the utility function becomes flatter, and this reflects the property of diminishing marginal utility. Now, what we mean by diminishing marginal utility is basically that the additional satisfaction you get from having an additional dollar decreases the more money. For an example today, if you walked in and found $100 just laying on the street, you might be pretty satisfied. But if Bill Gates walked in and found $100 laying on the ground, it wouldn't be that necessarily significant for him because his wealth is so much greater. And so that's what utility tells us. Now, for a risk-averse person, notice that with this principle, if this is someone's current wealth, this point here, this middle point, and they gain $1,000, notice how much their utility goes up. It goes up a little bit, but more importantly, notice how much it doesn't go up if they lose wealth. If they lose $1,000, there's an even more significant drop in their utility. And so this difference, the idea that gaining $1,000 nets a diminishing benefit versus how much we dislike losing $1,000 is an example of a risk-averse person. Basically, this means if I gave you a game that it's 50-50, you gain $1,000 and 50 you lose $1,000, you probably wouldn't want to play that game because you're more likely to lose money, and we prefer not to lose money versus gaining money. Now, this is core to the creation of insurance, and the markets for insurance suffers from two types of problems. The first is that usually we have adverse selection, and adverse selection is basically high-risk people are much more likely to seek insurance, and that means premiums go up. So just as an example, health insurance is something that someone that is likely to have a very expensive condition would much prefer to have because there's an obvious benefit to them having health insurance. It's going to help their cost, etc. But for someone that is quite healthy, health insurance is something that they're not as incentivized to get because right now they're of the opinion that, oh wait, I don't really need this. To give you an example of how this can be very specific, think about athletes. Athletes insure parts of their body like their legs or their arms, the things they use to perform their job. And this is a very expensive insurance. Why? Because the people more than likely to need this are athletes. And so this is one of the difficult challenges is how do you design a healthy insurance market for like college athletes who can't make money right now, but might get an injury that prevents them from going pro. The second aspect of this is moral hazard. And this is that with insurance in place, people are more likely to perform risky actions. So for example, knowing that an athlete is insured and knowing that they're not at risk of losing completely the amount of money they have if they injured their body, does this make athletes a little more aggressive in the gym? Does this make them a little more aggressive on the field? These regarding the 2007-2008 financial crisis is we had a combination of adverse selection and moral hazard market for mortgage loans. Now, there are ways to combat risk. First and perhaps most important is diversification. And what diversification means is it's the reduction of risk achieved by replacing a single risk with a large number of unrelated risks. So, for example, the stock market is full of risk. Any given stock, it has some degree of risk. But it is very risky to bet your entire retirement in a single firm. In contrast, it is less risky to bet your fortune across several stocks, several unrelated stocks. And so, as we mentioned in the last class, a mutual fund is a form of financial institution which you only buy into the mutual fund, you buy a share in the mutual fund, but the mutual fund diversifies risk for you by allowing buying stocks in several firms as opposed to buying single stock in a single firm. Now, risk is measured by statistic called standard deviation, and this measures volatility and the likelihood the variable will fluctuate. And so basically, risk through standard deviation, we're able to guess kind of how much is a variable going to deviate within a range of value. To give you an idea of what this looks like, over here in figure 2, we show how diversification reduces risk. And what this shows us is how a portfolio with a certain numbers of stock will reduce overall risk. One firm, you basically have a 50-50 shot. The firm will either go up in value or it will go down in value. However, if you increase the number of stocks you own, notice that this risk starts to go down. And the reason this risk starts to go down is that what we know is that while each individual firm may have a 50-50 option of going up or down in its value, most firms go up, for example. That might be what we're getting at here. And so that means that by having more firms, the ones that go up will much more likely offset the ones that go down. But notice here in this equation that we don't entirely eliminate risk. We still have about this 20% risk remaining. And the reason why, no matter how many stocks we add to the portfolio, the reason why is because market risk remains. And what we mean by market risk is this is the risk of an economic downturn. So even though your company is maybe doing well, there could be a general no matter what else they've done, and ultimately allows firms, it is a risk that you can never completely get rid of. So basically, we have to account for the fact that there is no such thing as a sure investment. Reason why. Now, the trade-off between risk and return is actually one of the cores of finance. The riskier an asset, the higher return required to induce someone to purchase it. So if the return doesn't promise you a high enough return and it seems quite risky, it doesn't make sense to get it. So therefore, risk and return are directly correlated. So in this sense, what we're saying is that the higher the risk, the higher the return. And so notice the trade-off between risk and return in figure 3. Deviation. And what this is telling us, yes, I've increased my stocks. Yes, I'm selling that. I have a higher chance of an 8% return, but part of me having a higher chance of an 8% return is that I am at risk for 20% fluctuation in value. This makes it a little tricky. But to give you an example of where this can pay off big, there is a firm that posted, I believe, it was something like 3,000 or 4% return over their 20-year operating. And this was a firm that basically invested exclusively in smaller firms. And what they found was that even though 95% of the firms they invested in went out of business, this company posted a record 3,000 profit. And the reason why was because one of those small firms was a little firm by the name of Google. And so Google hit it out of the ballpark, even though all the rest of the firms didn't. But the huge returns on Google were so high, it offset the entire losses they incurred everywhere else. This comes to something we call asset valuation. And asset valuation is dependent upon something called fundamental analysis. Fundamental analysis is the study of a company's accounting statements and future prospects to determine its value. There's two components to this: the price of the firm ownership, i.e. the price of its stocks, and the value of its shares. And what we mean by the value of its shares is how much of the company, how much assets are there in the company backing those shares. If the price is greater than the value, we consider a firm to be overvalued. If the price is below the value, we consider a firm undervalued. So in this case, if the stock price is below the value of assets backing that share, we say that's undervalued. And then if price equals value, it's fairly valued. Now, calculating value is hard. This is based on fundamental analysis, which determines present value versus future value. And there's actually some really fascinating research by a guy named John Cochran, which really explores the principle of how we determine the future value of assets. Now, beyond this, there are a few general economic theories that compete to explain why the stock market operates the way it does. The first of these is what we call the efficient markets hypothesis. This takes the view that markets are quite rational. And the way it says that is that the theory of asset prices reflect publicly available information about the value of an asset. So basically, whatever the value of Microsoft is today is informed by all the possible information available publicly, and that the markets have adjusted to reflect that. Efficiency, and that means the description of asset prices that rationally reflect all available information. So by posting information about firms, by posting information about markets, reporting on these things, the value of firms must be accurate reflections of that information. However, there are firms that are variables that have what we call a random walk, and this is the path of a variable whose changes are impossible to predict. So one critique of the efficient markets hypothesis, or at least one argument springing from the efficient markets hypothesis, is that the fluctuation in the value of stocks is a reflection of the fact there is some random walk. We can't exactly predict what information is going to be available or how that information is going to inform what the value of the firm should be from where it was previously, and this is a random walk. Now, a key name in this industry is a guy by the name of Eugene Fama, and Eugene Fama is an economist at Chicago who did work on the efficient markets hypothesis and developed it formally. In contrast, the next competing theory is what we call market irrationality. And market irrationality argues animal spirits, which are waves of optimism and pessimism. And this term comes to us from a guy by the name of John Maynard Keynes, a remarkably important economist we will revisit later in this text. And by animal spirits, what we're talking about are the idea that if people are super enthusiastic about a good, then there will be a buying high. If we think the market overall is good, then more people will buy stocks. If we think the market is bad, more people will sell stocks. And that markets fluctuate between these waves. Are speculative bubbles. And speculative bubbles are an overpricing which reinforces overpricing, leading to an upward spiral in the price above value. So for example, if everyone thinks that a company like Tesla is going to be super successful, they buy stocks in Tesla. Tesla's value goes up, which means more people buy stocks in Tesla, which drives up the value further, which means more people buy stocks in Tesla, and so on and so on and so on, even if the value of Tesla is not justifiable. And so this is one of the big debates, is whether or not firms are, if speculative bubbles exist. Because the efficient markets hypothesis would say, no, this is not true. Informational efficiency tells us that The value of Tesla is exactly what it should be. Well, market irrationality argues that no, Tesla is only a response to the fact that its value has gone up and that has reinforced other people to buy it. The key names in this philosophy are Robert Shiller and Daniel Kahneman. Both these men, Daniel Kahneman particularly, is a psychologist, and Robert Shiller is a neuroeconomist, I believe. But this brings us to the conclusion. Yep, this is a shorter chapter, but it doesn't highlight an important point, and that point is that stock prices often reflect general economic fluctuations, as stock prices reflect expectations of firms' future profitability. And that is something that springs from the fact that if we combine informational efficiency and if we combine market irrationality, we find that stock prices are fluctuating reflections of both the information we have available to us and individuals' own assumptions and expectations of how the market should work. And so that fundamentally is why finance is such a key important industry and why it plays such a crucial role in how it operates and functions. Now, in the next chapter, we're going to get into unemployment, but after this, we're going to get into monetary theory. And what we're going to find is in monetary theory, these questions of future value, present value are things that haunt how we just. All right, thanks, guys. Hope you enjoyed, and I will see you all later. Take care. Have